Hello, my awesome accounting students. Welcome back to a new chapter. In the previous chapter, we talked about the sales side of the house for merchandisers. Today, we're going to talk about the purchasing side of the house. I hope you're ready to learn a whole new vocabulary. Let's get started. This chapter explains how an organization manages its purchases of goods for resale and its accounts payable. The buying side of the house will require a new set of accounts as well as new journal entries for the buying or the purchasing transactions. In addition, we'll talk about the importance of internal control in the purchasing process, and eventually we'll introduce the other side of the house, subsidiary ledger, the subsidiary ledger for accounts payable. Because of the large amount of money spent to buy goods, most businesses develop careful procedures for the control of purchases and payments. Management and the accounting staff need to work together to make sure that there are good internal controls over purchasing. A careful designed system of check and balances protects the business against fraud, errors, and the excessive investment in merchandise. Part of the internal control of purchases is these documents that you see on the screen. The book does a very good job of showing you what each one looks like and the purpose for the document. So invest the time in reading through the book and understand what each one is for. When someone requests that a good needs to be purchased, they fill out a purchase requisition. In it, they describe exactly what they want, and they can list some specific vendors if they feel led to do that. The purchasing department then issues a purchase order and sends it to the selected supplier. A receiving report is made in the warehouse when the merchandise is received. Once all of this happens and the accounting department receives the invoice from the supplier, all the documents are matched up to ensure that the item was received at the properly agreed upon price. Once all of this is verified, then the company can pay the supplier. Again, invest the time to understand how a proper purchasing department is set up. Just like on the sales side of the house, the purchasing side of the house will require the knowledge of a new set of accounts. In this chapter, we will be accounting for purchases and purchases-related transactions. As we did in the last chapter, every time you learn an account, ask yourself 3 things. What type of account is it? What's its normal balance? And which financial statement will the account appear on? On the screen are 4 new accounts that we will be utilizing throughout the chapter. Each one of these accounts is a type of expense, so all of them will go on the income statement. As we will note as we go through them, some of them are contra accounts. This means you'll have to be extra careful when learning how they work. The vast majority of the money spent in a merchandising entity is on the purchase of merchandise for resale. We will be using the purchases account for this. The purchases account is one of the largest expense accounts that a merchandiser has. Like a normal expense, it has a debit balance, and we will use it to record the merchandise inventory that we purchase for resale purposes. Next up is purchases, returns, and allowances. When a business returns merchandise to a vendor, it makes an opposite entry to that of a purchase. But instead of crediting the purchases account, a credit is made to the purchases, returns, and allowances account. It is a contra expense, and it will keep track of all the merchandise returns that a business makes. Because it's a contra expense, it has a normal balance of a credit, Eventually, you will see that just as we did in the last chapter, these contra accounts will pull the main purchase account down. Next one up is the purchases discount account. This records cash discounts that we take for early payments and taking advantage of discounts offered for prompt purposes. We did something similar in the sales chapter, but the sales discounts were for goods that we were allowing our customers to take. Purchases discounts will be the discounts that we take for early payment to the buyer. It's also a contra expense, and so it has a credit balance. The final account on this slide is freight in. Freight in is an expense account that will use to track the incoming freight on merchandise that we will turn around and resell. Freight in has a debit balance and will be added to the cost of the purchases later on in the chapter. Just like invoices have payment terms, companies also have different freight terms. The two major freight terms are FOB shipping point and FOB destination. FOB, or free on board, means that the buyer pays the freight charge. That would be the cost of shipping it from the seller's warehouse to the buyer's location. This is the most often used in terms of sale. FOB shipping costs will be debited to the new account called freight in. In fewer cases, FOB destination freight terms are used. This means that the seller pays the freight charge. This would go to another account called freight out. There are two major ways to handle the freight charges when they are paid by the buyer. The buyer is billed directly by the transportation company for the freight charge. Think of FedEx or UPS. They bill the company directly. Sometimes the seller will pay the freight charge and includes it as a courtesy on the invoice. Make sure you understand the difference between the two shipping freight terms and read more about it in your book. While we are on the topic of freight, here's an example where the buyer pays the freight. The journal entry is to debit purchases for the amount of merchandise that was purchased for resale, in this case $4,760. In addition, there was a freight cost incurred because the terms were FOB shipping. That expense is debited to freight in with the credit to the vendor in the amount of $5,120. Let me note at this point that when freight costs are incurred, you are not allowed to take a purchase discount on the cost of freight. Keep that in the back of your mind, as that will come up later in the chapter. Sometimes we may not be satisfied with the goods we purchased. From the buyer's standpoint, when merchandise is returned, we credit the contra account called purchase returns and allowances. Although this account is used to track both returns and allowances, they are a little bit different. A purchase return is a physical return of the unsatisfactory goods. Perhaps you didn't like the color or the quality wasn't up to your standard, but you physically returned the good. A purchase allowance, on the other hand, is just a reduction in the price of the goods because you weren't satisfied. This means that you don't physically return the good, but you just ask the seller to grant you an allowance due to the goods not being exactly what you expected. Both physical returns and purchases allowances are recorded in the same account. Don't forget, this is a contra expense account and will always be credited. Here is a journal entry for a purchase of merchandise on account. Immediately following that transaction is a journal entry for a partial allowance on some merchandise that the buyer was not happy with. Both physical returns as well as allowances are credited to the contra expense account called Purchases, Returns, and Allowances. Take a moment to review the slide, as both of these transactions are common with merchandisers. Let's take a look at how these two transactions would be recorded and the resulting amount paid. This T account shows the original purchase, resulting in a charge to accounts payable of $5,120. Then the allowance of $476 is used to offset or reduce accounts payable. The resulting balance in accounts payable is then paid within the 30-day time period. At the day of payment, both accounts payable and cash go down. As we learned in the last chapter, sometimes there are incentives for prompt payments. Just as there were sales discounts on the seller side of the house, in this chapter on the buying side, we will utilize the purchases discounts to record any prompt payment discounts taken by the buyer. On the screen are several common payment terms. First, net 30 or N30 just means that payment in full is due 30 days after the date of the invoice. We saw an example of this on the previous slide. Net 10 EOM means that payment in full is due 10 days after the end of the month. These fractional payment terms that we saw in the last chapter also apply in this one. In this case, 2/10 net 30 means that the buyer can take a discount of 2% if paid within 10 days of the invoice. Otherwise, the full payment with no discount is due in 30 days. Purchases discounts is a contra expense account and therefore will always be credited. This is a reminder, as previously discussed, purchases discounts cannot be taken on freight costs. Those are outside the control of the person that sold them. So in this case, we bought something on account for $3,000, incurred a shipping cost of $200, making the total credit to accounts payable of $3,200. When the invoice is paid within the 10-day threshold, a 2% discount can be taken. However, that 2% is only applied to the merchandise, not the freight. In this case, the discount of 2% is only applied to the $3,000 purchase. Take a look at this slide and make sure you understand this transaction. This is a stumbling block in the chapter for some students. The last slide in this chapter has to do with the chunk of the multi-step income statement that is relevant to the buying side of the house. Take a look at the net delivered cost of purchases. Break that name down. Net means after deductions, just like your net pay means after taxes. So net delivered means include the freight, cost of purchases. In this calculation, we start off with the merchandise that we purchased, which is being summed up in the purchases account. We add in the freight costs to get delivered cost of purchases. The two contra accounts pull us down. So we subtract out the purchase returns and allowances and the purchases discounts to get the net delivered cost of purchases. In every chapter, we need to be mindful about learning the chunk of the income statement that relates to the chapter. That way, that upcoming multi-step income statement that we'll be studying later won't catch us off guard. This is Professor Johnson signing out.